When I think about Japan, it's never just charts and numbers. There's something that makes me want to slow down, look closer, and understand why this place moves me the way it does. And part of that journey is also learning to see Japan the way capital sees it. Because behind the calm streets and familiar buildings, there's a different set of forces quietly reshaping the market. Forces that has turned Japan's real estate into one of the hottest investment stories in the world. In real estate, we often hear the golden rule, right? Location, location, location. Developers have lived by that for decades. They focus on fundamentals, good land, foot traffic, transportation, building design. That's the developer lens. I started in real estate looking through the same lens, and most people around me did the same as well. But once I began working with real estate funds and meeting investors who move billions, I realized something big. The way capital look at real estate is completely different. Who is capital? Before we get to discuss on how they see things, we need to answer two simple questions. First, who exactly is capital? And second, what kind of relationship does capital have with real estate? When I started interacting with more institutional players, I kept hearing a term, capital allocator. These are the true power players in the global market. Think sovereign wealth funds, pension funds, major insurers, private equity giants. They control massive pools of money. That's their full-time job, allocating capital to different asset classes around the world. Being an investor, I'm also curious how the world's elite money managers lead and invest. These are the people who decide where the money flows. They don't just buy property, they want to shape the markets to their favor. Once you see through their eyes, real estate isn't just a building project anymore. It's a financial product. The relationship between capital and real estate is like consumer and product. Capital represents investment demand. Real estate represents the supply of investable opportunities. And just like any other product, if you want capital to buy your product, you need to understand its preferences, constraints, and alternatives. Because capital isn't loyal. It compares your deal against everything else it can possibly buy. Stocks, bonds, other markets, other countries. And it goes where the risk-reward ratio makes the most sense. I felt this firsthand when I started fundraising in Singapore. Investors would say, if I can get 6% annual return buying US Treasury, why would I put my money into your real estate project for 6%? Honestly, that's really hard to answer. And that's really hard to argue with, because that is the capital's mindset. Case study, Japan's real estate boom. This brings me back to Japan, because in the last few years, something fascinating happened in Japan. After COVID, Japan's property market suddenly heated up. Prices in Tokyo and all major cities jumped 30%. For a country people used to call the lost decades. That's impossible. That's shocking. And none of the usual fundamentals like, GDP growth, population, tech booms can explain why that happened. Japan didn't suddenly reinvent itself, but capital still flooded in. Why? To me, there are three key reasons: interest rate, exchange rates, and risk hedging. Number one, interest rate. While most major economies were fighting inflation with high interest rate, Japan stayed one of the few low rates markets in the world. For real estate investors, borrowing money from the bank is part of the game. When loan costs rise above project yields, deals stop making sense no matter what. We call that difference the spread. In many markets, spreads turn negative, but in Japan, spreads stay positive. That make it one of the most attractive financing environments on the planet. And of course, global capital noticed that. At the same time, the yen weakened dramatically, down 30-40% against major currencies over 5 years. When foreign investors converted back to their home currencies, Japanese assets suddenly looked very cheap. It was like a massive sale. And if the yen eventually strengthened, they profit on both property and the currency. That is a powerful double upside. The third reason is geopolitical. With US-China tension rising, European markets in slowdown, the global inflation creating uncertainty, Japan stands out as stable, predictable, and relatively low risk. For capital allocators, sometimes it's not about chasing the highest return. It's about finding a safe harbor. Even modest returns here can look attractive compared to losing money elsewhere. And when billions move with that mindset, the market sentiment can shift very fast. But here's the thing, when a boom is driven by capital flows rather than fundamentals, it can be incredibly powerful, but also incredibly fragile. Japan has seen this before. In the late 80s, global capitals poured in. Real estate, stocks, both inflated into huge bubbles. And when the tide turned, the crash shaped the country for nearly 3 decades. And today's 3 tailwinds, we have rates, currency, risk perception. They're all real, but they're also delicate. Interest cycles are shifting. The yen's past is political as much as economical. And safe harbors can become storm centers overnight. Remember, capital builds, capital can also vanish overnight. And understanding that duality is very crucial for investor. Today, we set the stage. We look at who capital is and how it thinks, and why Japan became its latest fascination. If you found this episode helpful, hit likes, subscribe, leave a comment, and follow along, because 2025 should just be the very early stage of our investment journey.